Welcome to the Allan Small Financial Show. Thank you, as always, for taking the time out of your busy day to spend it with us. As I've said many times, it's always a great show and a great time to have a show when the Federal Reserve is about to announce their latest interest rate policy. And as many of you would know, today at 2 p.m., the Fed, Jerome Powell, head of the Federal Reserve, will announce what their latest interest rate policy will be. We're not expecting a whole lot. Not much of a change going forward. We're thinking they're going to hold pat, but anytime the Fed has a meeting, it's always a dynamic situation. The markets will definitely move up or down depending on his commentary. We also have a great guest for you today as well on the geopolitical side of things, and we're going to speak to Matt in a brief moment. But here are our topics for our show today. We have China and the U.S. and the effect of China-U.S. relations on investing and investors in general. An interview with Matt Gerken. He's a geopolitical analyst, and we'll get to Matt in a few minutes. Top 3 things to consider over the next 10 business days. That is a segment that we have on every show because I like to highlight what I think individual investors should be focusing on before you make your investment decisions. Bank of Canada, first in the G7 to cut their policy rates or their interest rates. So of all the G7 countries, Canada was the first to cut interest rates, and they did that a few days ago, going from a 5% rate to a 4.75% rate, and we'll discuss that. Stock prices, and I guess the heading is a little misleading because if you read that, you won't know exactly what we're going to be talking about. Well, I'm going to be talking about why stock prices or the price of a stock is not the most important factor as to whether you should buy a stock or not. When you look at a stock and it's trading at $100 versus a stock that's trading at $50, one would possibly say the one at 100 is more expensive. Not necessarily. You have to do your homework and you have to calculate and evaluate that company's share price to see if it's actually more expensive or not than that $50 stock. We'll talk about that. NVIDIA surpasses Apple as the #2 most valuable company. We saw that happen earlier this week. And now today, as of this morning, Apple has once again surpassed NVIDIA. And in fact, has actually surpassed Microsoft as the largest company in the world once again. And as of this morning, Microsoft and Apple were flip-flopping, going back and forth as the #1 and #2 largest company in the world, followed by NVIDIA right behind it. I call them the trillion-dollar trio, the 3 companies that are worth $1 trillion and more. So we'll talk a bit about NVIDIA, how quickly they surpassed Apple. And now again, as I said, Apple surpassing NVIDIA once again. We have a new segment that I think we're introducing today, and hopefully we can include it in future shows. It's called Quick Hits. These are ideas that have been in the news quite a bit recently that investors probably have read about and may want to know a little bit more about. Quick little hits. We have 3 topics that I think investors have been noticing in the news over the past few days. So we want to bring some ideas regarding those topics to you. And lastly, your questions. As always, I want to get to as many questions as we can. Usually we get to 1 or 2 at the end of the show. If you have any questions, please put them in the chat box. If you're watching today, we've been getting a lot of comments on YouTube, which is fantastic. I try to answer as many as I can. Some of those comments on YouTube after individuals watch our show and watch our segments, getting a lot of feedback there, which is fantastic. Always welcome feedback. If you have any ideas regarding future shows, definitely would love to hear that. So without further ado, let's get on with the show and move on to our guest. I'd like to welcome Matt Gerken, Chief Strategist, Geopolitical Strategy and U.S. Political Strategy from BCA Research, a leading global investment research firm. Matt oversees BCA's coverage of market-relevant policy developments around the world. Previously, Matt worked as a senior analyst at Stratfor. BCA's Geopolitical Strategy Service provides market-relevant macroeconomic research with geopolitical risk analysis. resulting in trade recommendations for global investors. Matt Gerken, welcome to the show. Great to have you.
Thank you very much, Allan. It's a pleasure to be with you today.
Excellent, excellent. And as we always like to do, we want to have kind of a general conversation about our topic, which is geopolitical analysis. We have a lot to talk about, so I thought we'd get right into it with, I guess, a question, more of a general question, which is, right now, for the sake of the world and global economy, more specifically, we would love to see our two largest economies, China and the US, getting along, working together. However, based on the back and forth rhetoric, the tit for tat threats, the distrust between the two countries, I guess one would say these two countries perhaps aren't getting along as much as we would like. What's your take, generally speaking, on the state of the US and China relationship?
Well, first of all, Allan, I think your approach is correct that from an investment point of view, what we want is peace and prosperity. That's what investors want. That's what would enable a growing economy. That's what enables growing corporate profits and a free flow of capital to find the most efficient uses and generate better real returns. So the world is sort of, from an economic and financial perspective, the world is sort of looking for the US and China to form a détente or a reduction in tensions, because we've seen that their strategic tensions have exploded in the wake of the Great Recession. And specifically in 2014 and 2015, we saw the relationship break down. And then the election of Donald Trump escalated into an outright trade war. And we see today that the Biden administration has co-opted Trump's trade war tariffs, as well as expanding export controls that he initiated on high-tech equipment. And these things are going to continue regardless of whether Biden or Trump or any other Republican or Democrat gets elected in 2024. So what would cause that détente? What would cause the US and China to have a new mode of operating? Well, they would need to basically face the brink of an outright conflict, of a war, and recognize that that's not in their interests, and then back away from that and do confidence building measures. Some would be on the military side, others would be on the economic side. But I think if we want to cut to the chase, you need the US and China to sit down into a room and agree first that they will not attack each other's economies. They're not going to try to inflict a recession on each other or harm each other's ways of life. That would obviously escalate the conflict. They need to agree not to do that. And they also need to agree not to have a war over Taiwan. And China's view on that has been the same for a very long time. The Communist Party has shifted under Xi Jinping as well to be more aggressive, ultimately, on insisting on a resolution to the Taiwan issue. So there's not a lot of optimism about those 2 points of agreement, but it is possible over the coming years. The sad thing is it'll probably get more difficult first. We'll have bad news before good news.
So you mentioned a whole lot there, and a few points I wanted to touch on. Trade war, you mentioned that term. Do you think there's a trade war between the US and China today? Obviously, the US just introduced some new tariffs on Chinese goods coming into the US. Obviously, the tariffs on electric vehicles went up 100%. Do you think there is a trade war right now, and how is this affecting the North American markets?
Well, yes, I do think there is a trade war, and some of these terms can become, very loose, very fuzzy. They can be thrown around. Well, what we're talking about is a scenario where the US and China engaged in very deep economic integration and trade and investment flows, particularly since 1979, but it really escalated in the wake of 1992. And the US allowed China sort of quickly to enter the World Trade Organization in 2001. And then it started to break up again, like I said, after the recession, and especially when we saw that the result of the Great Recession was that the American consumers were not levering up as much. They were not, borrowing as much and spending as much as they used to on Chinese exports. And China, meanwhile, had sort of reached a peak in its export share of the economy and started to devote more resources to the property sector. And so those are big structural changes. And the reason why the U.S. engaged in China's economy was to peel the Chinese away from the Soviet Union. When the Soviet Union fell, then that relationship just continued to expand because it was positive for global economics, and it also seemed that it would create a coexistence politically and enable military and strategic tensions to be put on the back burner. And now we see that it didn't really succeed in doing that. One reason is that the Chinese did not engage in the degree of structural economic reforms that the West was ultimately expecting. The West wanted greater market access to China. And with the digital companies that the US, the software and services that the US was providing in the 2010s, China wasn't really letting those have access. It was worried about the effect on its society. And so we saw that the Americans and the West more broadly were disappointed with the amount of market access they were given. So there is a trade war, and it's because the engagement process failed. And that's because specifically China did not engage in the extent of structural reform. And then the Americans reacted very badly, including to the fact that they had deindustrialized their economy.
Valid points and great, I guess, lead up to perhaps a question regarding the companies themselves. A lot of companies obviously have a presence in China, Apple, Starbucks, some of the biggest chip makers in the United States obviously have a pretty big presence there. What would you say to these companies? How would you advise them? Are there risks going forward for continuing to have as much business in China as many of these companies do? And what would you say to investors that are investing in companies that have a large presence in China? What do they need to take into consideration before they make that investment? What do these companies need to take into consideration? Should they be diversifying away from China at this point? Or do you think that this at some point will get better, the situation, the environment will get better, and these companies are okay?
Well, a few things. First of all, the primary financial market impact of this trade war, it's involved a lot of different twists and turns, but generally speaking, we've seen US equities have not suffered. We're now several years into this process. It's a multi-year geopolitical trend, and the American market continues to thrive. The US continues to have an innovation machine. The US has a lot of capital, and foreign capital has fled to places like the United States, even in the context of higher inflation and higher interest rates, and a big ballooning of US budget deficits and debt. So what we saw was an exit of capital, first of all, away from Russia and Russia's sphere of influence because of the Ukraine war. But also, we have seen an outflight of capital away from China and Hong Kong. And so, in other words, it has not paid off for China to pursue a policy of economic sort of basically they didn't want to delever at home, but they definitely didn't want to lever up too much and create a bubble. So they sort of saw a slow decline in their property market as a result of constraining their credit growth. And this disheartened basically the property sector and also discouraged households, which have a lot of their wealth in the property sector. And meanwhile, the US was still offering very competitive and very productive and innovative companies. So capital has flown to the US. I think there's a lot of speculation about how that could change. But in order for that to really change fundamentally, China would need to undertake some of these reforms that I'm talking about. They would need to empower their households to consume more so that you'd have a consumer-driven economy in China. And then that would also outside powers would need to have access to that consumer market so that then they would have a reason to hold renminbi or renminbi denominated assets. And you could create a virtuous circle where exporters could export to China, save their savings and recycle them into Chinese financial assets and diversify away from the US. But that's really, none of that is happening. And there's not a good basis for that. China still has a closed capital account and they still refuse to transfer wealth to the households. So basically, this is an environment that's beneficial for US assets, and that can change at some future point, but it's not changing right now.
Yeah, so right now, I guess all these companies that continue to expand, Starbucks and many others, I guess for now, they seem to be okay.
Well, Look, I mean, the ones that are in China, that are based in China, and that are not providing technology and know-how that China needs, they are very vulnerable because when China retaliates to U.S. trade war measures, it can retaliate against some of those companies and limit their market share further. So it's not necessarily good for companies that are invested in China. And to your point about, what should investors do? Well, they want to look outside to other emerging markets because this conflict is driven by geopolitical factors, the need for security. It's not going away. And that means that the market access for U.S. companies will be limited. And other Western companies face a very similar dilemma.
And their stock price sometimes behaves. It doesn't get the multiple that other companies do, I guess, that are no not so reliant on the Chinese markets. I'm kind of changing pace a little bit with my next question. It's something that is in the news all the time, and I chuckle sometimes when I read about this. But in your opinion, does the U.S. have a good reason to believe that China is trying to influence Americans in general, how they vote on their elections through avenues like TikTok or other ways? Is the U.S. correct to think that they're being spied on, or is this just the U.S. being, I guess, scared or paranoid or whatever you want to call it? Do they have reason to believe that people in America are being influenced when they go on their TikTok feeds and read all the things that they're reading?
Well, I mean, countries are always trying to influence each other, and and also populations are often paranoid and fearful about various things. And what we see is because the superpowers are engaging in great power competition again, the way that they have historically, and we're sort of moving out of a phase that was focused primarily on trade and investment. We're moving back into a phase of more heightened competition. Well, this means that those fears are better substantiated and they will continue to grow. And that governments have a dual obligation. They have to try to protect the national security and protect their populations from outside interference and influence, but they also need to maintain economic growth and cosmopolitanism and the flow of goods and capital, and because they don't want to impoverish their people necessarily either by isolating them and reducing the productivity of their industries. So there's a balance to be drawn here, and I do think on the U.S. side specifically, we see a new fear of China that has gotten pretty powerful. You see it in both political parties. Historically, it suggests that the U.S. could overreact. The U.S. is often sort of late to the game when it comes to foreign or global developments, and then it overreacts. And that's because the U.S. is insular. It's more focused on domestic issues. When it wakes up to a threat from abroad, it then sort of panics initially. And so this could happen in the case of China. The U.S. was sort of slow to react that the Chinese were not making the changes that were expected, and we're starting to become more aggressive in their neighborhood. And then when the U.S. does react, that can go overboard if both political parties are fully if they're sort of competing with each other to see who can be more hawkish or more punishing toward China. So I think that's a really key dynamic. But also in terms of spying or whatever, of course, all these countries are spying on each other. They're escalating their espionage because they're very paranoid about technological breakthroughs in energy and in other areas. Artificial intelligence and quantum computing. These things have enormous applications for industry and military. And China has definitely accelerated intellectual property theft and spying and attempts to basically break through on the technological barrier because they have this declining economic model. They desperately need technological breakthroughs, and they don't have the same open scientific inquiry that the West has that enables innovation. And so they're not sure that they're going to be able to generate innovation at home. So yeah, I think there's a lot of that kind of activity between the two, and there's a lot of distrust, and it's definitely going to continue to blow up at times and cause the relations to get worse and cause distrust to get worse. Again, the two countries would need to get together and diplomatically agree to resolve or reduce this problem, and they haven't done that.
I guess regarding the I guess the technology part of things, and saying that obviously the West seems to be ahead of the game with respect to where China's at, leads us again to Taiwan and the fear that at some point down the road China could form a blockade, could invade, and we know that 90% of semiconductors are coming out of Taiwan today. What's your comment on that? Obviously, the world is trying to diversify outside of Taiwan right now because semiconductors, chips, the creation, the building of chips for everything, artificial intelligence is so important. What do you think the outcome is going to be there? Can you see a day or one day where China does go into Taiwan, or do you think that they will hold off?
Okay, well, first of all, Taiwan is extremely important for regional security because China has this long-standing conflict with Taiwan over the legitimacy, the rightful rule of China, and that's never going to go away. And the Communist Party is not going to be content until they have either subjugated Taiwan or in some way undermined this threat to their leadership. And so that's just an ongoing conflict. The powers around them are concerned about the situation because, if, for example, if you're Japan or South Korea, your vital supply lines go through the Taiwan Strait or around Taiwan. And that means that a Chinese military power capable of seizing Taiwan would also be capable of interfering with those supply lines. And those countries also expect the Americans to uphold their commitments. The U.S. it abandoned its mutual defense treaty with Taiwan back in the 70s, but it has always said that it would defend Taiwan against the use of force by China and try to maintain peace in the strait through deterring conflict. And so the U.S. is sort of committed to that, and we see the president saying we would defend Taiwan, and President Biden has said several times we would defend Taiwan. Well, the Japanese and others would expect the U.S. to uphold that, and if the U.S. didn't, then it would be a loss of faith in the U.S. security alliance. So basically, what this does is it creates enormous pressure around Taiwan. And the Taiwanese people themselves, first of all, they don't want to give up their liberty, their ability to have elections, their democratic system. They don't want to give up their security. They don't want to basically trade away their ability to defend themselves. So they want to maintain economic and military relations with the U.S. and its partners and allies. So this just creates a long-term conflict, and the conflict can be delayed for a long time, but it's not clear that it can be resolved peacefully. One, because the Chinese are moving more assertively towards some kind of resolution, and their view of resolution is that they get full political and legal and military control. The other thing is, the Taiwanese people have seen what happened in Hong Kong, where they made compromises, and ultimately it resulted in the loss of their special privileges. So it's really not looking good over the long run. Short run, it really depends on the situation, because China's not going to blunder into a full-scale invasion of a mountainous island that is defended by the U.S. and Japan. That would be extremely risky, potentially disastrous for the Communist Party. So they're going to play a more calculated game and a longer game, try to get better energy security and their own semiconductors, try to diversify away from the US dollar. But eventually, I do fear that it's moving in a direction of confrontation. Hopefully, a full-scale war can be avoided.
I guess my last question to you, and trying to ending off on a positive note, I guess, is there a way that both countries can forge a path ahead or forward to better relations? Is there a way that we could see positive outcome in the next, I guess, next few years? Obviously, we see this back and forth rhetoric on a daily basis, on a weekly basis. Is there a positive way forward?
Yeah, I mean, there's always a way forward. Hope springs eternal, and specifically with regard to politics, there's a tendency for those who did not know about geopolitics, once they discover geopolitics and the way that these nation states operate, they then can become very disillusioned and gloomy about the future. And I think there's reasons for that, because humans don't have the best track record over the long run of avoiding massive wars. Remember, World War II happened despite all of the progress in civilization for hundreds of years. So there are huge setbacks for humanity that occur. But when we're talking about international relations today, nuclear weapons present this issue of mutually assured destruction. So the leaders of these countries don't really have an incentive to engage in direct full-scale war. There's a perverse incentive there to have smaller wars or proxy wars because those don't threaten nuclear war. And so that does endanger their neighbors like Ukraine or Taiwan or other states surrounding these areas where there's a competition for influence and an attempt by Russia and China and others to create a sphere of influence. So I think there will continue to be proxy wars and conflicts, but there's not a major reason why countries would do desperate and disastrous things like fight direct wars with each other, these superpowers. And then in addition to that, we still see that China, of course, needs to create a more productive economy because they're no longer able to just grab the low-hanging fruit of export manufacturing or property construction. And so they're going to have to shift in some ways to create a more sustainable economic model. And the Americans are sort of hoping that they can use that as an entry point to negotiate a de-escalation with China. And that way the U.S. can maintain the status quo in the region, which is ultimately what the U.S. wants, having established that status quo after World War II. So I think what you're looking for is for China to move more in a direction of trying to stabilize their economy. And the very, very red flag, the big red flag would be if China has an even further downturn or even an economic crisis, and they do not respond in a pragmatic way to improve their economy, but they really double down on militarism and nationalism. That would be the red flag that we're really moving in a scary direction.
Matt Gerken, Chief Strategist from BCA Research. Thank you so much for being with us today and shedding some light on what I've been focusing on quite a bit over the last few years, the China-US relationship and how it affects and can affect individual investors and stock markets all around the world. Thank you so much for being with us and sharing with us your knowledge on this important relationship, world relationship.
Thank you, Allan.
Take care. Take care.
You too.
Now we come to the part of the show where I talk about what I believe individual investors need to be focused on or understand before they make their investment decisions over the next couple of weeks. As always, we have three topics. And the first one, U.S. inflation, CPI data, which was out earlier this morning, and the Fed decision that is about to be announced at 2 p.m. this afternoon. The second thing that I want to discuss is good news once again. A lot of people would say, well, isn't good news always good news? Well, not necessarily, especially when you're looking at inflation and trying to bring down inflation. And the third topic, are investors getting a little bit too confident? If you're an investor out there that's trying to invest money at this time at all costs and chasing those high-flying names, are you maybe a little bit too confident? At times there are, when the market does pull back, there are times when the market pulls back, and sometimes that catches people off guard. So you don't want to be ever too confident. So we'll touch on that. So let's get to the first topic, U.S. inflation CPI reading that we received this morning and the upcoming Fed discussion. So we did receive CPI, Consumer Price Index. We got some numbers out of the U.S. this morning, and they were pretty good. They were to the downside, and they showed us that inflation is starting to come down once again. A lot of people were thinking that maybe things will reheat or start to get a little bit warmer with respect to inflation. We saw pretty strong inflation numbers in the first quarter out of the U.S., and we were hoping that that was just a first quarter thing. Coming into a new year, sometimes pricing and inflation gets distorted, and hopefully that we would see things start to come back down again. And so far, for the months of April and May, that is in fact what we are seeing. First chart we have on U.S. Consumer Price Index will show us just that. Here you have the headline number, 3.3%, down from 3.4%, was as low as just above 3% at the beginning of the year. we're seeing the core inflation, which is less food and energy, the volatile food and energy, down to 3.4% from 3.6% just a month ago. So we are starting to see inflation coming down once again. Our next chart here, Fed funds rate. You'll notice the big takeaway here is that on the far right-hand side, you'll notice a flat line, and that tells us that the Fed has not lowered interest rates in a little bit. They raised interest rates multiple times throughout 2022, and as we came into 2023, or at least the latter part of 23 and 24, things have kind of stabilized. And obviously, the Fed is no longer talking about raising rates. They think they are in a spot keeping interest rates restrictive in nature. And so they think they don't need to raise rates. The question now becomes, how long do they have to keep rates in restrictive territory before they reach their 2% target for inflation? And the Fed has actually said that they will cut rates before they get to 2% in anticipation of getting to 2% down the road. And we've seen other inflation data showing us that inflation may be somewhere around 2.6, 2.7%. I know CPI is a little bit higher, the numbers we got this morning, but we're getting there. The US is getting there. In Canada, our rates have been under 3% now for quite some time, and that's why we've already seen Canada lower interest rates already. The second topic to focus on, this idea of good news is good news once again. And what I mean by that is, for quite some time when we had a strong jobs number, strong retail sales, strong GDP growth, that spooked the market because individual investors were saying, oh my goodness, if things are so strong, central banks aren't going to be so quick to cut rates. So we wanted to see a bit of a weakening economy, a bit of weaker numbers so that the Fed and the Bank of Canada could cut rates. But at the same time, we don't want to see too weak numbers, so that not too hot, not too cold scenario, that Goldilocks scenario that I talk about quite often, not too hot for the data, but not too cold. That would indicate we are going into a recession. So when we received, for example, jobs numbers out of the US and Canada this past Friday, the numbers, I believe, were warmer than expected, better than expected, but the market took it in stride as actually good news is good news. And we have some charts on this. We have Canadian jobs, I think is our first chart. You can see here that for the month of May, we created 27,000 jobs in Canada, which was well above what we were expecting. You could see not as high as what we created in the month of April, but nonetheless, we're still creating jobs. And when you have job growth, job creation, people are working, they're getting a paycheck, and they're spending money in the economy. We have our next chart here, which is a monthly job creation in the US. And you can see here that monthly creation, 272,000 jobs were created in the month of May, well up from April, not as high as where it was in March, but you can see that there was this downward path that started at the end of last year. The month of March was a bit out of whack there, but now we can see maybe it wasn't, because May was how we had some significant job creation as well. So I guess the main takeaway for investors would be, when economic data is strong, that's not necessarily a bad thing. It just depends on which data points we're getting strength in. So for example, our next chart shows that Canada's average median hourly wages in all industries for the last 5 years is on the rise. Wages are on the rise. Now that's great for all of us that are making more money, but not so good for the Bank of Canada, because we're seeing wage inflation. And wage inflation has been something both in Canada and the US that central banks have focused on. And so when people are making more money, they can spend more money chasing fewer goods, and there you have inflation. Our next chart here, and I believe, actually, no, we have two more charts. This is going to show you hourly earnings in the US. And to my surprise, you're actually seeing hourly earnings coming down. So again, maybe good for the Federal Reserve and the central bank in the US to see hourly earnings falling over the last, I guess, towards the end of or beginning of 2024. That's a 17-year period on this chart. but obviously not good for all of us, right? We want our hourly earnings to go higher, not lower, but from an inflationary standpoint, not a bad thing. So again, if we were to see some positive data there, that might be inflationary and worry the markets a little bit. And lastly, on this topic, retail sales, another topic that I think when you receive a number, not too hot, not too cold, we're seeing that retail sales, our last number here, US retail sales was actually pretty flat, not much growth whatsoever. That is a bit of a problem, right? Because that just tells you that the consumer is not spending as much as they were in the previous few months prior to that. And could this mean that the consumer is no longer has the ability to spend as much? Could this then eventually be a factor into how the growth numbers look like in the US and obviously in Canada down the road if the consumer is not spending? We know the consumer makes up about 70% of the economy. So if the consumer stops spending, that could be a problem. That could be a problem for growth in both Canada and the US. So a number like retail sales, we want to see a good number, but not necessarily not too good, but not too bad. So with certain data, good news is good news once again. With other data points, you might hear that good news may not be so good when you're battling inflation. The last point I want individual investors to consider before you make your investment decisions is this idea about, are investors too confident? And, we've seen markets go up quite a bit over the last, let's call it 6 months. We have a chart that will show year to date by month how the markets have fared. And really, with the exception of April, the only time that the markets actually went down, and we have that here. This is the S&P 500 index, a month by month chart on the S&P 500 index. We can show that chart right now. There it is. And you can see here, the only month that things went down was the month of April. All the other months, things were pretty good. The S&P 500 went up pretty well. And it's funny, in the month of April, I did receive many calls from investors asking me what's going on. Should we be sellers because things look like they're falling? Well, obviously back then we did not know that the months of May and June, so far in June anyways, things would look pretty good and that any losses in April would be made back up in May and June. But at that time in April, things looked bleak, right? The Fed was talking about not cutting rates anytime soon, and market was slightly, according to some, overvalued. So investor confidence at that point, or investors having confidence in the markets, actually went down. People were getting nervous again. And now here we are, markets back at all-time highs. So I guess the point I wanted to make with regards to investors being too confident at times is, you got to take what investors are doing and saying with a grain of salt. They're reacting emotionally to what's going on in the markets, to what they're hearing in the markets, what they're hearing in the media. And at times they get overconfident and they take markets to all-time highs. They chase those high-flying stocks. And it's funny how that confidence can erode, how quickly it can erode like it did in the month of April. So you want to be mindful of that, not to chase the hot stock. And I think we have a couple of more charts to show how strong the market has been this year. The S&P year-to-date bar chart here, you have a lot of bars. And the main thing, without showing the bottom, it's tough to see the numbers along the bottom, but you can clearly see how the S&P has gone from the bottom left to the top right with respect to how well it's done, with a bit of a blip in the middle, which was the month of April. And if you want to talk about the area where the growth has been most prominent, that has been technology. The Invesco QQQ ETF really is the one ETF that tracks the tech sector. And you can see here, once again, that as of November 1st, all the way up to present day with a bit of a sagging in April, the tech stocks have been on a roll and have done extremely well. So yes, there has been reason for individual investors to be confident, to become more confident, but you always want to, keep things in mind. You want to stay diversified. Don't chase the hot stock. Keep looking at those PE ratios. Keep looking at their price to earnings to their growth. You want to keep measuring these investments against other investment ideas, peers, competitors, things of that nature. So you can never get too confident. And in my opinion, those are the three things that I think individual investors should consider before you make your investment decisions. So the Bank of Canada was the first to cut rates out of all G7 nations, first central bank to cut. And the Bank of Canada cut a quarter point, as many of you know, went from a 5% rate down to a 4.75% rate. So that is in the rearview mirror. Now the questions all turn to, will they cut again? How soon will they cut? How many cuts will the Bank of Canada have or initiate by the end of the year? And how much can they actually cut if the Federal Reserve or the US does not cut rates? These are all questions that have been floating out really since we saw the first interest rate cut. And our first chart in this area is one that we kind of never really had before, which is one of my favorite charts. And it's the first time that we were able to put the Bank of Canada interest rate cut. There you see it there. You see it towards the end or the right side of the chart, 25 basis points versus the CPI or inflation, which is 2.7%. And then at the bottom, you have GDP. And the GDP is basically growth in our country. And you can see how it's been flatlining in and around zero or just slightly above zero, between 0 and 1% now for quite some time. So what does that tell us? Well, tells us that the Fed has definitely cut rates for the first time. Tells us that CPI or inflation is definitely coming down to 2.7%, as we can see here, down from, I guess a high of 8% a few years ago. And why is this happening? Well, I think the Bank of Canada is realizing that growth has been very small. There's not been much growth at all in our country for a while now. You couple that with inflation coming down, you couple that with some of the softness we're seeing in other areas in our economy, and that leads you to believe that the Bank of Canada will continue to cut rates. The question is, how much or how quickly will they cut rates? I think even though the Bank of Canada says they do have some wiggle room with respect to how much they can cut before we see a cut in the US, if we start to see maybe 3 or 4 cuts before the Fed, we see a 1 percentage point off our rate. So we go from 5%, let's say, to 4%, which is basically where you'll see in this next chart, if we can put it up, where the predictions are by our major banks in and around 4.25 by the end of the year, by December the 11th rate announcement. You compare that to the Fed, you're probably going to see our dollar fall further. Right now, we have a dollar that is between 72 and 73 cents as compared to the US. If we were to cut 2-3 times more, where would our dollar be? It's quite possible our dollar could fall towards that 70-cent mark and perhaps breach that, maybe temporarily. And in turn, that means that whatever we're importing from the United States becomes a lot more expensive. Our exports become cheaper, which is a good thing for our manufacturing sector, but it's our imports that become a lot more expensive and perhaps become inflationary in nature, because obviously prices go up when we're using our dollar to buy their goods if our dollar were to fall. So things become a lot more expensive, and therefore possibly we could see inflation start to pick up a little bit because of our currency declining. So we'll see how far the Bank of Canada can go. Next chart we have here, this is Bank of Canada versus the ECB, European Central Bank, and also the Fed is on here as well. And you can see that both European Central Bank, Bank of Canada made their first rate cut, but the Fed has stand pat. They're not going to cut, and it doesn't look like they're about to cut anytime soon. So today's meeting at 2 p.m., the Federal Reserve, Jay Powell will speak. We all know they're not going to cut rates, but what will he say with respect to when the first cut will happen? We're also going to see projections by the Fed. Last time we received projections, they were predicting 3 cuts, and perhaps they will now say maybe 1 or 2 only this year, maybe 1 in September and maybe 1 in December. That seems to be where the percentages are falling right now. So we'll see what the Fed says at 2:30 when they give their press conference. So the rate the rate announcement, not as important because we know there's not going to be a rate cut at 2 p.m. But more importantly, what will the Fed say come 2:30 when they have their presser, when they talk about what they believe is going to happen in the future? And I think in turn, that will affect what the Bank of Canada can do going forward. stock prices. And as you see here, in particular, stock price of NVIDIA. You know, when NVIDIA did a 10-for-1 stock split, for those of you, I'm sure most of you know that. So they split their stock by 10. So what that means is if the stock price was $100, it's now $10. But if you had one share, now you have 10 times as many shares, or 10 shares for every one share. So net effect is actually zero, right? Your value of your NVIDIA holding in your portfolio remains the same. You own more shares, but at 1/10 the price. And it kind of got me thinking, because I received a lot of calls at that time from individuals saying, hey, NVIDIA is doing a stock split. Should we buy? And was curious as to why people wanted to buy the stock just because it was splitting. Maybe it was because people feel as though now at roughly $120 a share that the stock was cheaper. Maybe they think that owning more shares is a better thing. I'm going to tell you right now that that's not the case. Owning more shares is not better. Owning a stock when a price, or buying a stock when a price is less, from, in this case, $1,200 a share to $120 a share, it doesn't really help any. It doesn't make a difference. What does make a difference, and how individual investors should look at an individual investment idea, is to evaluate that stock. So you could have a stock trading at $1,200 a share and be cheaper and better value than a stock that's trading at $165 a share. For example, NVIDIA, when it was at $1,200, was trading at roughly 42 times forward earnings, whereas AMD, a competitor to NVIDIA, another US chip maker, large chip maker, was trading at about $165 a share, but trading at about 48 times forward earnings. So NVIDIA actually at that time was cheaper than AMD, cheaper than Micron, another chip maker, cheaper than many other chip makers. So price of a stock isn't as important as valuating that stock, figuring out how much that stock, that company earns, comparing its earnings to its price and to its growth rate. And I think, to me, that is far more important than the price of a stock. One should not look at a stock trading at $100 as more expensive than a stock trading at maybe just $10 or $15, because it's all about how many shares are outstanding, how much that stock is earning, what the price is. That's why you tend to see at times when a company announces a share buyback or a stock buyback, where the actual company is buying back its own stock, that is actually a good thing, because it's removing shares off the market, and that is a good thing for the share price. Our chart here that I wanted to show on NVIDIA, 25-year history of stock splits, and we're going to get into stock splits in our next segment. But I really wanted to show you how much the price of NVIDIA has changed, right? With all the different share or stock splits. You've seen the latest one, 10-for-1, and you've seen to the far right-hand side how much the price has come down. So when you're looking at whether a stock is cheap, whether you should be buying it, look at its valuation, evaluate that company, do your homework. If you're not able to do it, call your investment advisor, call an investment advisor, send me a message asking me if I think a particular investment idea is cheap and good value. That's what we want to look at. We don't want to look at necessarily whether a stock is just a higher price versus a stock at a lower price. To me, that doesn't matter. It's all about valuating that company and its shares going forward. So NVIDIA, yes, as we said off top of the show, at one point surpassed Apple as the #2 largest company in the world. That has now changed as of this morning. Apple announced just the other day their Apple Intelligence. Most of us will call it artificial intelligence. And the market initially did not really seem to think that was a big deal, but a day later, a bit of a, I guess, delayed reaction. Apple has surged once again, 6-7%, over $11 a share just yesterday. And Apple now is fighting with Microsoft to be the largest company in the world, once again, surpassing NVIDIA. But what I wanted to touch on with NVIDIA, and the reason why I bring it up is it's probably the #1 talked about stock in the world right now. Wanted to show you just how fast NVIDIA has moved. And, you know, is this an attractive investment today? I just talked a bit about it last segment. Our first chart here, NVIDIA stock market value overtakes Apple. We can show here, you can see what happened in NVIDIA, how fast NVIDIA stock, which is the green line, how it caught up to Apple and Microsoft, which are I guess the orange and blue lines here. NVIDIA, in my opinion, is definitely not finished yet. They continue to innovate, they continue to grow, and it would not surprise me to see NVIDIA become the largest company in the world at some point in the not so distant future. But is it a good investment today? I think there are other ideas that I would look at first. NVIDIA now trades at around 45 times forward earnings, definitely not cheap. But if the company continues to innovate, if the company continues to grow at its current growth rate, then yeah, 45 times forward earnings is not expensive. But this is the question. Can it continue to maintain its growth rate? I will argue that a company like NVIDIA will struggle at some point, and they'll become a victim of their own success. How much or for how long can a company grow earnings over 200% year over year and grow earnings as they have quarter over quarter, month after month? At some point, their rate of growth will slow. And at that point, I would imagine investors will say, well, is this as good as it gets? And the stock price will come down. But for now, NVIDIA tends to be, as I say, part of the trillion-dollar trio at the top of the heap. And everybody else is trying to catch up going forward, like for the likes of AMD, Intel. These are Marvell. These are chip makers that will continue to battle NVIDIA and hopefully, for their sake, try to take more and more of the artificial intelligence pie. This is a new segment of our show where I talk about a couple of quick hits, quick ideas that many people are talking about when I go out and have my conversations with investors. First one, contentious capital gains tax appears. We're all talking about the new increase in capital gains tax and how that's going to affect investors' decisions, how that's going to affect small businesses and business folks. Will they take their business elsewhere? Well, for those that have the means to take their business elsewhere, will we see a bit of an exodus from Canada into the United States in places like Florida and Texas where taxes are a lot less? Tesla AGM. This is a meeting going on where they're going to vote on the pay package for their CEO, Elon Musk. Elon Musk is pushing for a $56 billion pay package. Will he get that? And third quick point or quick hit, Apple talks at their AI Worldwide Developers Conference. While they're talking about AI, I should say, at their Worldwide Developers Conference, we had all their announcements earlier this week on Monday. And as I said, the stock has definitely responded positively. So let's get to the first one, our first quick hit. Contentious capital gains tax appears. We have our first chart on that, which shows that the higher capital gains tax may only affect, or at least so the government says, 0.13% of the population. I'm going to tell you that that is not the case. That yes, there's a very small percentage of the population that make over $250,000 of capital gains every year, which is what the government's saying, and that increase in inclusion rate will only affect those that are making over 250,000 of capital gains. But understand that if you own a corporation and if you're investing in that corporation, if you own a trust and you're investing in that family trust or formal trust, that higher inclusion rate, 66.67%, will affect you as of $1 of capital gains. So it's going to affect a lot more people than just 0.13% of the population. The next chart we have on this, you can see that capital gains is a fairly big chunk of the income by percentile. Dividends being the smallest one, obviously wages and other income is first. Capital gains is a very large part. So to me, all this talk that we're hearing out of our federal government that this is it's going to affect a small part of the population. You're hearing some people say, oh, this is just a small, it's not a big deal, it's something small. And then they talk about how it's going to inject $19 billion into the federal government to be able to pay for certain things. So is it small or is it going to inject $19 billion? I think $19 billion is a big number. So I don't think it's as small as people think. And anytime you're raising taxes, to me, that is an issue. That will be an issue for a lot of people. Already, Ontario is the fourth highest jurisdiction, fourth highest taxes jurisdiction anywhere in North America. So this raising capital gains tax inclusion rate, to me, just doesn't make sense. And it may cause many to think twice about starting a business, growing a business, and may think twice about living here in our country. And you may see more and more people moving down south. The second quick hit I wanted to talk about was Tesla. And we have, I believe the meeting results will be out tomorrow. Elon Musk, in a contract, or at least so that's what we're led to believe, in a previous contract, was expecting to be paid $56 billion. A big number, huge number. It's not like something we see every day. And there's been some pushback from the board, from investors. They don't want to pay Mr. Musk a $56 billion package, especially considering what the stock has done recently. Let's take a look at the chart of Tesla. We've seen this chart of Tesla here. Tesla stock has fallen significantly from its previous highs. Once upon a time, it was a $1 trillion company. Now less than half a trillion, or less than 500 billion. So we've seen that Tesla stock has not fared too well, but yet Elon Musk wants to earn what he has been promised. And the board and many investors are pushing back, saying that is not the case. You shouldn't earn that much. Let's restructure your pay package. And we'll see what the results are when they announce those at their meeting tomorrow. One thing I wanted to show just very quickly, top CEO compensation. I thought this was a very a good chart to show. We've seen this was back a little while ago. This is annual compensation 2021, as you can see on the far right. Elon Musk, just a couple of years ago, making over $10 billion a year. We saw the CEO of Rivian, another electric vehicle company, coming in second. Tim Cook, Apple CEO, and then fourth, the CEO of Lucid. So out of the top four highest paid CEOs, three of them were CEOs from electric vehicle companies, which I find quite interesting. And what you don't see here are CEOs there like Amazon, Microsoft, Alphabet. So very interesting to see who are in the top paid CEOs today. Obviously, that may have changed in the last few years, quite possibly has changed. But the fact that Elon Musk, in wanting that $56 billion pay package, it will definitely make him, I believe, the highest paid CEO in the land. The last topic, the last quick hit, obviously all the talk about artificial intelligence and how Apple is going to incorporate artificial intelligence into its products. We have a chart of Apple here. You can see how it blew through its former highs of around $198, $199 a share. Today sitting at over $200 a share. When this chart was taken, up 5, almost 6%, $11 of growth of their share price, which was, I believe, yesterday we took that. And yeah, it's now challenging for the biggest company in the world. Is Apple still a good value today? I'd probably argue that based on its earnings, it is not. Trades well over 30 times forward earnings, yet its growth rate has been somewhere in the vicinity of 5 to 7% year over year. So does that name like Apple with a growth rate that low garner such a high multiple? In my opinion, not. But yet everybody seems to be excited that there's going to be a new refresh of their hardware, of their iPhones, of their iPads, and their Macs. When they incorporate artificial intelligence into their products, everyone's going to have to upgrade and want to buy new products. So maybe the price is justified going forward based on future potential and what will happen with iPhone and Apple in general, what will happen with their sales. Now the part of the show that I like best, trying to take as many questions as I can. I know the show went a little longer today. Our great interview with Matt Gherkin went a little longer than anticipated, but we had some great information. Matt talked to us about pretty much many different things regarding the China-US relationship and his opinions on where things can go, where things have gone in the past, and perhaps a positive way forward. So want to just take one question, and it relates to this whole capital gains and increase of capital gains tax. With June 24th date approaching, should I be selling my stocks and realizing capital gains before June 24th, 25th, I believe, is the date that the inclusion rate looks to be going higher. And my answer to that is you can realize capital gains. However, if you think about it, for the average person, what are you going to do with that money that you're selling off these stocks or funds or bonds or whatever you're selling? The proceeds of the sale, what are you going to do with it? If you're going to reinvest it back into the market, and if you're reinvesting into a corporation or you're investing in a trust, then you're still going to have that same higher capital gains rate. Unfortunately, there's no way to win here. If you're planning on selling it off to, buy a home or make a purchase or use that money somewhere else, and you're not planning on reinvesting it, then yes, it definitely would make sense. If you're using that money, you're going to make that sell inside a corporation, or if you have more than $250,000 of capital gains tax, yes, it would make sense to sell before the June 24th, 25th date. However, obviously, this proposal needs to be voted on. We're now hearing that the Conservatives are not going along with it. We'll see what the NDP say, and if this bill is eventually passed and capital gains tax is increased. Most of us are expecting it to be increased. So getting back to the question, I wouldn't be so quick to sell. It's just dependent on you, what you plan on using the money for, where your money is being held, whether it's in a personal account or a corporate account or a trust account. So there are a lot of factors there. My advice to you would be to call your investment advisor. Again, if you would like to give me a message or leave me a message or give me a call, I'd be happy to answer that question as well. With that, I want to say thank you to everybody who tuned in to our show today. I thought we had a fantastic show, pretty good with respect to information. At times, I think maybe information overload. We try to get as much information to you every 2 weeks on the Allan Small Financial Show. So you can catch our next show 2 weeks from today, 12 noon, Wednesday, June the 26th. And until then, happy investing.